Welcome traders and enthusiasts to today's video where we'll unravel the world of common chart indicators. As we embark on this journey, we'll be shedding light on the role of these indicators, their function, and how they can significantly enhance your decision-making process in the financial markets. Whether you're a seasoned trader or just getting started, understanding these indicators can be your key to informed trading decisions. These tools help in market analysis, risk management, timing trades, confirming trends, strategy development, and even automation. They are not just symbols and lines but the language of the market, a dialogue between you and the financial world. If you find value in our content, don't hesitate to show your support by liking, sharing, and subscribing to our channel. We appreciate your engagement as we dive into this intriguing subject. Let's dive in. Before we delve into specific indicators, let's explore the intentions behind using them. In the bustling world of trading, indicators serve as vital navigational tools. Traders use them as a compass to interpret market trends and as a barometer to gauge risk. They're the secret sauce in timing trades just right, and the pillars upon which successful strategies are built. In the vast ocean of financial data, indicators help confirm trends, anchoring decisions in facts rather than hunches. As we move into an era of automation, these indicators are also the lifeblood of trading bots, guiding them in making calculated moves. And of course, they're a treasure trove for those keen on learning, offering rich insights into how markets move and behave. The ultimate intention? To empower each one of you to make informed, smart trading decisions. Now let's explore some key indicators. First up, we have moving averages. This is a fundamental tool in the trading world, often used to smooth out price data and provide a clearer picture of the market's direction over a specific period. Now, there are two types of moving averages that traders commonly use: simple moving averages or SMA and exponential moving averages or EMA. Let's break these down a bit. Simple moving averages are calculated by adding up the closing prices of a security over a specific number of time periods and then dividing this total by that number of periods. It's a straightforward average, hence the name simple. On the other hand, exponential moving averages give more weight to recent prices. This means they respond more quickly to price changes than SMAs, making them especially useful in fast-moving markets. But how do traders use moving averages? Well, they serve as a line of support or resistance. When the price of a security is above its moving average, it indicates an upward trend, and when it's below, it suggests a downward trend. Also, when a shorter-term moving average crosses above a longer-term moving average, it's known as a golden cross, signaling a potential bullish market. Conversely, when a shorter-term moving average crosses below a longer-term one, it's called a death cross, indicating a bearish market. One key thing to remember though is that moving averages are lagging indicators. They are based on past prices, not predictive of future movements. Yet, they are valuable in identifying potential trends and reversals. In essence, moving averages are a simple yet powerful tool in a trader's arsenal. Whether you're a day trader or long-term investor, understanding how to interpret moving averages can help you make more informed decisions, enhancing your trading strategy. Moving on to the Relative Strength Index, RSI. RSI is a momentum oscillator that measures the speed and change of price movements. This is the key concept we're diving into now. The Relative Strength Index, or RSI, is a powerful tool that traders and investors use to gauge the momentum of a particular market. Here's a bit of background. Developed by J. Wells Wilder in 1978, the RSI is a technical indicator that oscillates between 0 and 100. It's used to identify overbought or oversold conditions in a market, which can provide traders with valuable insights into potential price reversals. So, how does it work? The RSI calculates the average gains and average losses over a specified period, typically 14 periods. The result is an index that ranges from 0 to 100, with levels above 70 indicating overbought conditions and levels below 30 signaling oversold conditions. Now, why is this important? When a market is overbought, it means that there's been a significant upward movement in price, but the market might be running out of steam. Conversely, when a market is oversold, it indicates a significant downward trend, but the market might be due for a bounce back. Let's delve a little deeper. One of the ways traders use the RSI is by looking for divergence between the indicator and the price action. If the price is making higher highs, but the RSI is making lower highs, this could be a bearish divergence, indicating a potential price reversal to the downside. Similarly, If the price is making lower lows, but the RSI is making higher lows, this could be a bullish divergence, signaling a possible price rebound. Remember, like any other indicator, the RSI is not foolproof. It should be used in conjunction with other tools and analysis to make informed trading decisions. The beauty of the RSI lies in its simplicity and versatility, making it a favorite among traders of all levels. Now let's talk about Bollinger Bands. Bollinger Bands help traders assess volatility and identify potential trend reversals. Named after their creator, John Bollinger, a financial analyst, these bands are a type of statistical chart characterizing the prices and volatility over time. They are one of the most popular and widely used technical analysis tools in the trading world. The structure of Bollinger Bands is relatively simple. It consists of 3 lines. The middle line is a simple moving average, and the 2 outer lines are standard deviations away from this average. These standard deviations adjust to the price actions. When the market is calm, the bands contract. When the market is volatile, the bands expand, reflecting the increased price variance. The width of the bands is a direct indication of the asset's volatility. Traders use Bollinger Bands in several ways. One common method is the identification of overbought and oversold levels. When the price touches the upper band, the asset may be overbought, indicating a potential sell signal. Conversely, when the price touches the lower band, the asset may be oversold, suggesting a possible buy signal. Another approach is to look for price breakouts. A breakout occurs when the price moves outside the bands. This could indicate a continuation of the current trend or the beginning of a new one. Bollinger Bands are also used to identify the so-called Bollinger Bounce. It is based on the idea that price tends to return to the middle of the bands. When the price bounces off the lower band and heads towards the middle line, it's often seen as a bullish signal. Remember, while Bollinger Bands can be incredibly useful, they should not be used in isolation. They are best used in conjunction with other indicators to confirm signals and prevent false alarms. Last but not least, the MACD, or Moving Average Convergence Divergence. As we move forward in our exploration, we'll uncover how this powerful indicator helps traders identify changes in momentum and potential trend reversals. Until then, keep those charts open and your minds sharp. This indicator combines 2 moving averages to identify changes in momentum and potential trend reversals. Welcome to the world of Moving Average Convergence Divergence, or MACD. At its core, MACD is a trend-following momentum indicator that shows the relationship between 2 moving averages of an asset's price. Here's how it works. The MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The result is the MACD line. A 9-day EMA of the MACD, called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. Traders may buy the asset when the MACD crosses above its signal line and sell the asset when the MACD crosses below the signal line. But that's not all. MACD also includes a histogram. The MACD histogram is an elegant visual representation of the difference between the MACD and the signal line. When the MACD line crosses above the signal line, the histogram will climb above the zero line. And when the MACD line crosses below the signal line, the histogram will dip below the zero line. Now, how do traders use it? Well, MACD can be used in several ways. One of the most common uses is to look for divergences. A divergence occurs when the price of an asset is moving in the opposite direction of a MACD indicator. This could be a signal that the current trend is weakening and a trend reversal may be on the horizon. Another common use is to identify overbought or oversold conditions. When MACD rises dramatically, that is, the shorter moving average pulls away from the longer-term moving average, it's a signal that the asset is overbought and will soon return to normal levels. And there you have it, a brief overview of some common chart indicators. The MACD is a versatile tool that can help traders identify changes in momentum, short-term trends, and potential price reversals. But remember, no single indicator should be used in isolation. Always use multiple indicators to confirm your analysis and never stop learning. Stay tuned for more insights into the fascinating world of chart indicators. Remember, successful trading is a combination of various factors, and these indicators are just tools in your toolkit. Today we've explored moving averages, the relative strength index, Bollinger Bands, and the moving average convergence divergence. These indicators can help you make informed trading decisions by identifying trends, measuring momentum, and assessing volatility. So, Take the time to understand them, experiment with different combinations, and tailor your approach to your unique trading style. Don't forget to like, share, and subscribe for more insightful content. Happy trading!